Good morning, good afternoon, or good evening, ladies and gentlemen, depending on when you are watching this video. Now, in this video today, we'll be talking about the going concern concept and the appropriateness of using the going concern basis in preparing the financial report. So let's get started. Firstly, please note that going concern and the going concern assumption is covered by ASA 570. Now, this is a really important standard because going concern is actually an incredibly important part of the assessments we need to make as part of our audit. So this very naturally leads us to the very first question. Tia, what is going concern? Now, when this concept comes up in class, I often ask students one very simple question, and that is, when you see or when you hear the concept going concern and whether a business is a going concern, what do you think that means? Do you think it's a positive concept, or do you think it means something negative about the business? Now, in most cases, students often focus on this word here, on concern, and they think that that word means that it's actually a negative concept. I'm here to tell you today that you need to actually focus on that first word, going, because ladies and gentlemen, the going concern assumption is basically the assumption that the business will keep going into the foreseeable future. It will keep operating into the future, which basically means it's not going to go out of business voluntarily or involuntarily anytime soon. So that's really important. So remember, when you hear the term going concern and the going concern assumption, it's the assumption that the business, the entity, will keep on going. It will keep on operating into the foreseeable future. Okay, so the technical definition, I'm just taking it to the next step now. The technical definition of going concern is this view that the entity will continue operating in business for the foreseeable future without any intention or necessity to liquidate or otherwise cease its operations. Now, to add a few more details to that, going concern is essentially about making sure that the company can pay its debts as and when they fall due. That is why we're saying that they will continue operating into the future. So they'll be able to settle any debts that they have, and therefore will continue to operate, and will continue making sales, and therefore will continue operating into the future. Now, as I keep saying this future thing, these foreseeable future concept, please note, if you didn't know this, write it down. The future, the timeline that we're actually focusing on is 12 months. 12 months from the date that we sign our audit report. So this going concern assumption that we have is, will the business keep on going? Will it keep operating within the next 12 months? Will it continue operating for a period longer than 12 months after we sign our audit report? Now, what's important to note is that management it's firstly management that makes an assessment as to whether the entity is a going concern. So then what happens is, we as the auditor, we then consider this assessment to determine whether it is appropriate. Highlighter here, appropriate. So management first thinks about the situation and thinks, okay, is this business, are we going to keep on operating? Are we still a going concern? We as the auditor, we then consider that assessment and we determine whether it's appropriate. So we as the auditor, we ultimately have to come to a conclusion about whether we think there are any issues with the entity being a going concern. So we look for what we call going concern issues or going concern problems or uncertainties. And I'll take you through those in just a little while. The reason why it's really important to make this assessment, guys, is because, and I'll highlight this for you here, is because we use what's called a going concern basis when it comes to preparing and presenting the financial report. And when I say we, I mean management. Now, you might be thinking, well, what does that mean? I want to focus on this concept here, going concern basis. Ladies and gentlemen, when it comes to management and the directors preparing the financial report, they have to prepare it on a certain basis, right? So a certain set of rules that govern what needs to be included, how the information must be prepared, and how that information must be presented. Now, believe it or not, there's actually two main bases upon which we can use to prepare the financial report. So let me take you through those and show you why it's important to make this assessment. So the two bases that can be used when preparing the financial report is the going concern basis and the liquidation basis. Now, please note before I go any further, it's one or the other. So it's a versus situation. The business will either prepare the financial report based on the going concern basis or the liquidation basis. So this leads us into, well, what's the difference between the two, and when should the business use the going concern, and when is it appropriate to use the liquidation basis? So the first one, the going concern basis, this is the one that's appropriate when the business is in fact a going concern. So the assumption that the business will keep on operating into the future is indeed correct. Alternatively, the liquidation basis is the basis that must be used when preparing the report when the business is no longer a going concern. So that's the difference between the two. The going concern basis must be used when the business is going to keep on operating into the future, and the liquidation basis is what needs to be used when the business is no longer a going concern. That means that the business will be closing down or going out of business within the next 12 months. And guys, that can be voluntary. That could be because the owners or management have decided to close down the business, or it could be involuntary. It could be, for example, as a result of bankruptcy. Okay, so ultimately it comes down to the question of, will this business keep on operating for a period greater than 12 months, or is it going to close down shop? And that will determine which of these rules the business must follow when preparing the financial report. Now, let me just give you one example of when deciding this is very important. Let me give you one example of when you'll see those differences come through. So, for example, under the going concern basis, when it comes to recording the value of our assets, we do so in most cases, we do so at historical values, which means we record the value of our assets at the cost and how much it cost us in order to purchase the asset. Now, when it comes to the liquidation basis, remember this is the understanding that the business will not keep on operating, but will rather close down the business within the next 12 months. Under liquidation basis, the assets must be valued at market value, or fair value is the other word we use. And that means that we must record the value of the asset and how much it can be sold for now. How much we can sell the asset for in the market now. The reason is the liquidation basis, we must record the value at what we are going to get once we liquidate the business. Okay, so remember, when a business closes down, they sell all their assets. So the value on their balance sheet for these assets must be the value they're going to get once they sell the asset, because of the assumption that because of the understanding that the business will close down shop. Over here with the going concern assumption, or the going concern basis, we record it at cost because the business will keep on operating and therefore the market value is irrelevant. And we keep doing our accounting as per normal. So this is just one example of when it's really important to determine the basis correctly, because it can result in very different information. Okay, so as I said earlier, management first determines, are we a going concern, yes or no? And it's based on that they start to prepare the financial report. We need to consider that assessment. We need to determine, is it appropriate for management to be using the going concern basis when preparing the financial report, or should the business use the liquidation basis. Now, this is really important because, as I said, it can result in very different information. And if we get it wrong, or if management gets it wrong, it can result in risk of material misstatement. Okay, that's why it's really important, because if they get the basis wrong, it can result in the whole foundation of the report being incorrect. So that's why this is a really important assessment that we make, because it will impact on the whole foundation upon which the financial report is prepared. So in making the assessment as to whether the business is indeed a going concern or not, we look for any indicators of going concern problems. Are there any uncertainties? Are there any indicators that highlight there might be a problem with the business's ability to keep on operating? So in the next slide, I'm going to take you through the 3 categories of going concern problems. So as part of the audit, we must be alert to any indicators of going concern problems. So anything that may be a red flag, anything that may indicate that their business is having issues or will have issues in their ability to keep on operating into the future. So there's any uncertainties regarding the going concern assumption. Now we have 3 different categories of indicators. So we've got financial indicators that may show the business will have financial difficulties, which will impact on their ability to keep on operating, operating indicators, as well as other indicators as well. Now, I'll take you through a few of these that you can see on the slide, but I'd like to highlight that there's a bigger list of these in your textbooks. So if you refer to table 6.2 on pages 274 to 275 of your textbook, you will see a wider range of examples for you. In addition to that, and I strongly recommend everyone to go and check this out, again, ASA 570 is the auditing standard that covers going concern. So if you refer to that standard, you'll find a much longer list of examples of each of these categories and each of the indicators that fall under each of them. So please make sure that you do that. It will help you quite a lot with your understanding of this topic. So let's go through these indicator categories. The first one was financial indicators. Now, financially, what would indicate to us that the business may have difficulties in continuing operations? Well, a really good example of that is if they have, I'll just highlight this for you, negative operating cash flows, which means if they are making more cash payments than what they are receiving in cash. So more cash is leaving the business than coming in. Now that's a really, really big risk, because if the business is paying more cash than what it's receiving, it will ultimately cause a lot of strain on their ability to, remember, pay their debts as and when they fall due. So we always look at cash flows, because cash flows is a really important element here. Believe it or not, guys, the success and the strength of an organization is not based off profit. It's actually based on cash flow. So looking at their cash flow and making sure they have enough cash resources is really, really important. Something else that may indicate that they might have going concern issues is if we look at their financial ratios and they don't look very good. So for example, they have a really a current ratio that's less than 1. Now, a current ratio that's less than 1 will indicate that for every $1 of current liabilities, they have less than $1 in current assets to cover them. So that may indicate, again, a going concern problem. It may indicate difficulties in paying their debts as and when they fall due. From a profit perspective, another indicator might be if they're not making profit, but rather they're making losses. Consistent, continuous losses, period after period, is a really big indicator that things might not be okay. In addition to that, if the business has a lot of debt, or they have a lot of debt, or they're unable to get necessary financing, that may really impact on their ability to keep on operating. So inability to obtain financing, or if they have a lot of debt. Remember, debt is a really significant risk because when it comes to loans, which is debt, loans, you have to pay them back. The business has to repay the loan with interest. So if they have a lot of debt, they have excessive debt, it puts a lot of strain on the business, and that may indicate a difficulty in continuing their operations. Now remember one very important thing. What comes with debt? Debt covenants. So we always, as part of an audit, we always look into the covenants. We make sure that they're not close to breaching the covenants, and we also we place more audit attention on the areas relating to debt covenants, because that might be a risk area where they might manipulate information to make sure that they don't breach them. So we do look at whether the business is having difficulty in complying with their debt covenants and the terms of their loan arrangements. So those are just some financial indicators. Now you might be thinking at this point, well, yeah, that makes logical sense. If the business is making losses, if they don't have very good cash flow, if they have a lot of debt, yeah, that makes sense that would be a problem in their ability to keep on operating. My response to that? Exactly. This is all very logical stuff, to be honest with you, but it's just about knowing when to bring this knowledge or bring this understanding into the audit process and when it becomes relevant. The second set of indicators, the second category, are operating indicators. Now, a really good example of an operating indicator that may become a problem for the business is if they lose key management personnel. Let me give you an example. When Steve Jobs passed away, there was legitimate concern about whether Apple could keep on operating without him, because he was seen to be such an important person, such an important factor in Apple's success. So when he passed away, it became a bit of an indicator, a bit of an uncertainty regarding whether the business will keep on operating. So that's an example of that. Another operating indicator could be if the employees within an organization are doing striking. They're performing strikes on a continuous basis. So if you think about a few years ago, Qantas had a very big problem with their employees being on strike, and that caused a significant impact on their business, and that was an operating indicator. Another thing, again, under operating indicators would be competition. Right? If there is a great deal of competition and the competitors are being successful in their ability to take the market from this particular business, then that could be another indicator that the business may not be able to survive. So if they lose a significant portion of the market because there's a lot of competitors coming in and taking that market share away, that might be another indicator of an issue. Also, if the business relies on trademarks or patents for the success of their business, if a patent expires or they lose a patent in some way, that can also be a significant problem. Now, one thing I just want to highlight at this point is, remember what I said earlier. Going concern means the business will keep on operating into the future, right? But when the business is no longer a going concern, it's not just because they've gone bankrupt. It can also be because they're choosing to close down the business. So another operating indicator is, well, if management wants to cease operations. If they've made that decision to close down the business, obviously that's a massive indicator that the business is no longer a going concern. I'll quickly touch on some other indicators that don't fit into the financial and operating category. An example is lawsuits. That's a really big one. If the entity experiences or gets involved in a lawsuit and it looks like that the lawsuit may not end in their favour, that can have a significant enough impact on the business to cause them to go out of business, right? Another example of that is if there's a disaster of some kind and the business doesn't have insurance. That can also be a significant hit, and that might be sufficient enough to cause them, to close their doors. The final one is if there are any adverse changes in government policies or procedures or regulations that may impact on the business. And I did mention a really good example of this one in class, and that was with the solar panel industry. Remember, with the solar panel industry, the government changed their policy in relation to assisting people in helping them actually buy solar panels and install them on their roof of their houses. As soon as the government changed that policy, it caused many businesses in that industry to go out of business. So that's another indicator that we can think about. So again, guys, this is not an exhaustive list. This is just some examples of indicators that we must look out for. Indicators that may make us uncertain about whether the business will keep on going into the future. The final thing to talk about are the presence of mitigating factors. Now, this is really important because, as we discussed in the last slide, there are many things that we may look at which can indicate a going concern problem. It can indicate the business will not be okay. It's not enough for us to just look at those indicators and reach our conclusion that no, the business will go out of business, they are not a going concern, but rather before we reach that conclusion, we must also consider the presence of mitigating factors. A mitigating factor, ladies and gentlemen, is any factor that can reduce the going concern risk. Right? That can mitigate the issues that we have identified. So it's essentially any avenue or even any resources that the business has available to it, which will alleviate, which isn't just another word for reduce, alleviate or reduce the going concern problems that the business may experience. Okay, so this is really important because we can identify a going concern issue, but the business may have a strategy as to how they're going to counter that issue so they can keep on operating into the future. Okay, so it's really important to identify going concern issues and uncertainties that we have, but we must also think about and discuss or identify, are there any factors, are there any avenues or resources the business has available to it to reduce these pressures, to reduce these going concern risks or issues. Now, what are some examples? Well, a really good one is if the business is experiencing financial difficulty, and that's a reason why they've got a going concern problem, well, do they have the ability to raise money somehow? Can they sell their shares? Can they sell their assets, I should say, and get cash, which can hopefully alleviate the financial difficulties that they have and can help them to, again, pay their debts as and when they fall due. If they have a particular project that's quite expensive that's coming up, or if they wanted to, for example, they wanted to purchase new expensive assets, well, can they delay? Can they delay that project? Can they keep the cash in the business for now and then engage in this investment activity a bit later on? Right? When it comes to debt, can they renew or extend their existing loan so they don't have to have the difficulty associated with having to pay the loan off now? When it comes to not making profit, well, can they reduce their costs and therefore hopefully help their profit or reduce the cash payments that they are making? In terms of cash or resources or financing, once again, do they have the ability to raise more money from their owners? Can they sell more shares? Or as we said earlier, can they borrow more money? So these are just some examples of mitigating factors that reduce the going concern risks that we may identify, because it's showing us that the business does have avenues or resources available to it to actually reduce those risks, to reduce those uncertainty, to ensure the business can indeed keep on operating into the foreseeable future. One more example of a mitigating factor actually would be a good one to note is if we're looking at a particular subsidiary. So I might write this down up here. So if we've got a parent company and we are auditing the subsidiary, another example could be if the subsidiary is experiencing issues, right? This one's experiencing financial issues. Can the parent company help? Because if the parent company steps in and say, look, if my subsidiary has any problems, I will step in and I will help them, guys, that's also a mitigating factor. Okay, so we can't just identify the problems, the going concern issues. We must also think about, well, are there any additional factors that may reduce those issues as well. It's only by thinking about both of these that we can get to a better and more accurate conclusion regarding the business's ability to keep on operating. And just like that, we reached the end of this video. Well done once again for getting through all of this content. If you do have any questions, please let me know. Otherwise, have a wonderful day and I will speak to you in the next video. Bye guys.